Hello, I'm almost Mongolian, investor in Voxtur. I'm doing another interview with the CEO and executive chairman of Workster, Gary Yeoman. This time I took some input from other investors before this interview. So some of the questions I ask have been requested by other investors. And so do you have any starting comments before I start the questions?
No, I'm just, grateful again for your investments and that your interest is here, and happy to answer the questions today.
All right, so I'm gonna go straight into the thing that's on everyone's mind. I think because it was a bit unexpected from the previous communications that the race was going to be this big. So I guess the question is, why do you need so much money right now?
Well, the answer is that we don't need it. All right. We left a position out there that essentially we've got, a couple of options to go. Number one, we need liquidity for some of our business units to kick in and start making some money. The banks required us to have more liquidity than we had right now. So that, wasn't an option. And so the banks were looking at somewhere around, they wanted to have somewhere around $12 million US that they wanted us to have. Obviously, we had some liquidity, but we left some room there to see where the interest was. Right now, we're, I think, about, as of yesterday, about $12.5 million. There's no commitment that we have to go higher. Which is basically garnering the interest. But the most important thing is that we need liquidity by the bank. And I think that ultimately the bank wants us to, reduce the existing debt that is there right now, so they get more in line with covenants. And so sometimes the things that we want to do are not always falling in with the timing that actually happens. Believe in the company, believe in the business plan, believe in the execution of what we're doing. Sometimes timing is not always perfect. We had a, material setback, with the auditors resigning. That was not have anything to do with Voxtur. And we had a couple of other issues that have happened that became fairly punitive from a monetary standpoint for us to pay. And so it hurt on some of our liquidity. And so as a consequence, we needed to do a raise to satisfy the bank, and we needed some flexibility in there. So whether we do 12 million or not, I'm not going to say. We just see and garner what the interest is out there. I realize that nobody wants us to dilute that business in any way more than what we already have. I also realize that it's important that we work in tandem with the bank, because the long-term health of this company, I believe in very strongly. And, and I'm very, very convinced by business unit, and depending upon the line of questioning today, that each have a unique set of circumstances that are going to be very bountiful for Voxtur. So it really gets down to timing, and our accessibility to capital and when things kick in. And it gets down to timing of the bank too, and their patience with respect to us meeting some of the obligations of the covenants. So the answer is that we put it out there as an option, but we didn't put it out there as an obligation. And we'll just see. We meet with the banks, regularly, and we'll gauge, their, what their wants, desires, and wishes are.
All right. So from the raise, it was possible that you'd raise 20 million if you get everything, and obviously with the warrants that
there's a possibility, but not a guarantee.
Yeah. So how much do you need for you, let's say, not to need, so you don't need to raise more money, like let's say in the next 12 months or 6 months?
No. I mean, listen, when I go through each business unit, we fully expect that Q2 will be similar to Q1. Q3, we're going to start seeing some improvements in the latter half of Q3, and Q4, we expect that the company will be profitable. And so everything is aligning up this way with a number of various, new contracts and that we're getting. And so we're pretty excited about our future. The money that we've raised today should get us there. I mean, as long as there's no hiccups along the way. So we feel fairly comfortable with that. And if we do, we'd use some of that money, obviously, to reduce debt too. But when it's all said and done, it's really not about whether we do 20 or not. It really gets down to the execution, in our business units, so that we can mitigate the amount of dilution that we have. So right now, we put it in there because when you go and do a raise, if you say 10 million and you actually need, 13 or 14, you can't go back. So if you say 20 and you only take, 13 or 14, then that's fine. But you can only do it once. And so just, just like we said before, when we talked about, when we moved to a larger board, whether it's NASDAQ or not, we said that we could do, it got shareholder approval up to, I think it was 15 times or something like that we could, do a consolidation. We had no intentions, of that. So, but what you do is you do it once, and you get approval, and then you have flexibility in between. So this is where we are right now.
Yeah. I mean, nobody likes the dilution, but I think the worry that people had when the raise was upsized was that the cash, like from operations, the cash burn would have been much higher than we would have thought before, or that the bank would want to get paid much sooner than we thought, like that the relationship was not as good as it was before. So that was the worry.
Well, I think our relationship is really good. I mean, I've had a relationship for 25 years with BMO. I've made nothing but money for BMO, and we've been excellent custodians of their money over that 25-year period, and they've been even reciprocally equally as excellent partners in helping us, build our companies. But there's always limits, right? And it really doesn't get down to personality. It gets down to execution and performance. And we've had, when I say setbacks, not failures of any of the business units, but timing. We expected our real property tax analytics to have been completed 6 months ago. We expected, some of the, when interest rates, increased 3 times. It had material impact, on our business. And so it slowed a lot of opportunities that we thought were good. Let me give you an example in Blue Water's case. We had a very large client who was taking a large piece of our business, or providing us with a large piece of our business. By virtue of the interest rates increasing, the cost of MSRs went from $4 to $6. All right. And so as a consequence, when the bank recapitalized based on the $6 value, they were at their limit and they couldn't buy any more MSRs because they had actually exceeded what their total component is that the bank allows them to invest in any one entity. So all of a sudden, there's a 6-month reprieve. What does that cost us? It costs us a lot of money on a monthly basis for contributions, a few $100,000 a month. That hurt. With respect to Round Point selling, after our close, Round Point was providing us up to $500,000 a month. We didn't lose the business, but what was required was that they had to take their correspondence or their banks and reload them in. To date, of the 580 that they had, there's only about 45 that have been loaded to date. So now our flow is starting to come again, but that wasn't contemplated. business is not a straight line, and really what it gets down to is how do you adjust? How do you pivot? Our business is good. Our business is going to be very good for the future, but it requires us to make decisions that really get down to what is in the best interest of the company and the shareholders long term. Because you can win battles and lose wars, or if you want to lose a war, sometimes you have to lose a few battles. And so ultimately, we never make a decision that's not in the best interest of the shareholders long term. And so if we need some liquidity because we need to buy some time for some of these things to kick in, then that's what we need to do. Do I really want to face and come to you and the shareholders and tell you that we need to liquidate more than what, or dilute more than what we wanted to? Of course I don't. In fact, as I think I've told you before, I mean, I had some shares that vested. I had to pay close to $900,000 in tax. I had to borrow that money, and the shares are still sitting, in my account. I didn't. Most people will sell enough shares to pay the tax. I didn't, and so I borrowed $900,000 to pay the tax. I had a draw that was given to me to offset, the shares that I will be receiving and bonuses. I waived that and paid $1.2 million back in that draw. So 2 months ago, about 2.5 months ago, I went out and borrowed $2 million, between the interest and that draw to pay back that I didn't have to. If it wasn't in the best interest of the company, if it wasn't in the best interest of the shareholders, if it wasn't because I didn't have confidence, because I had confidence of where we're going as a company. So whatever pain, the individual shareholders and your constituents are listening today have had, I pretty much tell you that I feel it 10 times more. In addition, I've got another $3.5 million of my own money that I put into this. So, what I'm saying to you is that I'm committed to this company. I believe in this company. As little as 2 months ago, I basically ate, $2 million of costs that I had to go out and I had to borrow. And so when it's all said and done, I'm not trying to make this feel any better, but if there's any issue about, who's, having to deal with, the after effects of further dilution, probably me more than anybody. And so, like, I care deeply about you and your shareholders. I care deeply about getting a return. And ultimately, the decisions that we make, as a management team and as a board, is that what is in the best interest of the shareholders long term. And it's a marathon. It's not a sprint. And so I could go through each business unit and tell you some of the challenges, but I think if you're investors who are very intelligent and very well read, if you go to our comparables, like Real Matters, for example, who went from basically 70 million of profit to they're losing money today, and they're not going to deliver a year end of EBITDA. They're going to be a negative EBITDA losses. Companies like Doma and Blend have fallen off by 90%. If you look at real estate tech companies, we're not the only ones that have had a little bit of strife, and ours were further mitigated by a number of different issues. But a big one was basically was the auditor and the whole mess that we had to turn that around. It cost us millions of dollars to deal with that basically that backlash. There are other things that I'm really not going to get into, but it's just the perils of being in business, and the perils of what does interest rates do and how do you pivot. We've actually increased our gross margins, from originally when most of your investors started at about 25%, and last quarter it was 47%. We actually fell off in our revenue by almost $8 million, yet our gross profit ultimately was the same. So you're starting to see some of the pivots that are happening right now with the injection of more technology and higher margins, and hopefully that will continue to improve as we go to the end of the year.
I thought of a question there, like, what's your goal on the gross margin? Like, let's say long term, what do you think your gross margin?
Our gross margins by the end of this year, we want to be north of 60%. We want to be. For the last quarter, our gross margins in 2024, we think that we can get them north of 75%. And we think our profit margins will be north of 60%. We really, I've taken my staff, and we've went from 440 people, and by the end of this quarter, we'll be around 200. We've cut everywhere we possibly have cut. And as evidence, you've seen the improvement in our margins. And we found a number of areas where our technology is now, starting to, take effect, and you will see improvements in our company. But I'm really, suggesting to you that probably the last, third of the third quarter and the fourth quarter is where these material gains will be evidenced.
Yeah.
So it's not a year from now. It's like 4 months from now, right? 5 months from now. And so, I really am apologetic, that we have some dilution. I am. It's not something that we wanted to do. But ultimately, you're trusted to make the right decisions for the company for the long haul, and this is what we're doing.
Yeah. The corporate cost, I heard you say, was in the other interview, that they went from, they're going to go from 4 million to 750,000 per month.
775,000. I think.
It was, you said, by the end of next year. What do you think you will get to by the end of this year?
No.
Or was it by the end of this year?
This year, yeah.
All right.
Yeah.
Right. So
listen. We have no people writing memos for the memos. Like we've knocked out our marketing department. We've cut down our HR department. We have cut our staffing, by over 50%, or will be, by the end of this quarter. I mean, we basically cut everywhere we cut. I don't have an executive assistant. I'm setting up my own, meetings and my own, Zoom calls and team calls. I mean, basically everything we're doing as little as we possibly can. As far as, there's no frills whatsoever. Everything is just bare bones, because we realize we're in a situation today with higher interest rates. I mean, our interest rates have basically, our costs from the bank as far as interest have more than doubled. I mean, and so we have, those costs, and how do we deal with that? How does anyone deal with that? And so we realized at the bank that we're going to have to do something. And so what we said is we started looking at some of our businesses that are non-strategic, meaning we can't convert those to technology operations and they're low margin. So we're going to have to look at some of those and contemplate whether, we're going to divest of them. And in some cases, we may not have a choice. We may have to do something to mitigate debt. I'd love to be in a position that, all I have is an operating line and no term facility, because then, you're doing the things that you need to do without having, to also look at your partner and make sure that you service them as well. Banks are an amazing thing, and Bank of Montreal have been amazing to us and amazing partners. But, they need to, be satisfied that the term facility that they've lent us is going to be attended to. And we haven't met the criteria for them, which is 3 times EBITDA, which we were challenged to have by the end of this year. And so, we think that we're going to be tracking towards that, as far as in the quarter. But when it's all said and done, it has to be some, basically some concessions by everyone. And so that's what we're trying to do.
Yeah, I noticed like Q3, you got a waiver. You broke the covenant, you got a waiver, and this the Q1, and this also what kind of got people thinking about the bank, like you didn't get a waiver for Q1.
Well, we did. like we not,
Are you
you know,
good?
basically what, well, let's put it this way. Basically we're dealing with them every month, talking to them every week. They know that we're working on it. We've made, they've laid out requirements for us to make sure that we're in good standing, and we've met those, and we're continuing to work with those. The bank believes in us. They love our business, and they know that we've had some setbacks, and they totally understand that they're not of our own making in every case. So they're working with us, and we're satisfied based on the plan that we have, the plan that we've basically laid out for them, that those issues will be dealt with. And, by, at some point in time in the third quarter, but at the very latest, probably by the beginning of the fourth quarter, that a lot of those issues would have been dealt with. And, it'll be a go forward with vigor and enthusiasm, and putting some of the stresses and pressures of, of what we got right now in front of us, hopefully, in the rearview mirror.
Yeah. I promised to ask this question. It's from a bit more skeptical person than me. So I think this is like, he wants to know whether this could be possible in theory. In times of government breach, does BMO have the possibility to call the loan, all question mark, part of them question mark, and what kind of delay Voxtur would have to pay in this scenario?
I think that any loan that's made by any bank, they have a chance to call it anytime they want. All right.
Yeah.
It's just, it's just their prerogative. I mean, it's not worrying about us, but it's worrying about themselves, right? There's all kinds of things that can happen in the world today, whether it's, like we had, the too big to fail banking crisis, in 2008, et cetera. Any bank can call any loan at any time. They don't. And if you take a look at, in BMO's case with us, they believe in us. They believe that they have an opportunity to make a lot of money from us in the long term. And it's in their best interest, and in your best interest, and our best interest, that we, work out a plan so that we can get back on track to meet that success. I fully believe 100% that we're on board and on track to do that. All right, I do. But, news to you and your shareholders, go find me, a loan covenant anywhere that the bank has any, has any condition in there where they can't call any loans at any time. It's just not the way the world works. But they wouldn't be in business if that's what they did, is loan you the money today and called it tomorrow. In their history, that's not what they do. What they do is that if they have massive concern in your ability, then they start looking at recuperative measures to do so. And so there's been no kind of insolvency. There's no discussion about that. They're very, confident in their future. But yes, we have to do some things in the future. And some of those are taking a look at our non-strategic assets, and we're considering that. And, we're very, very comfortable that we'll be able to deal with the debt. In fact, we're hoping that, by the end of the year, maybe we don't have a debt facility. Maybe we just have an operating line. So, all of those things are working. We're working with the bank in conjunction with that. And, essentially the companies that don't have debt, have confidence. But again, it's not where we are today, but our performance as a company, with respect to gross margin increases and not falling off by, kind of 90%, like our other comps. I mean, I'm not justifying that what we're doing is acceptable, but I would ask the constituents to understand what the environment is in the world today, and what the environment is for other tech companies today, and have some understanding that what we are doing is the right thing, calm, collected, measured in our thought process, collaborative with the banks, and we too shall deal with this.
Yeah, you made that. You said in an interview you did Marius recently that you would like to be debt free by the end of the year, and that obviously got a lot of people thinking that that 60 million Canadian. Like, where would you come up with that? Like, is that the disposition? Are you like
Combination of a few things. One is a potential some disposition, some JVs. As I say, some capital infusions. So, I think that one of the things you can look at is replacing a current debt with, there's other options in convertible debentures, that are way more attractive interest rates, and dealing with it and getting an extended term where there's no calls or anything like that. We're looking at a lot of things right now. Sorry, my phone rings from time to time. I'm not sure if I come off your screen, but I am trying to get it turned off. So I apologize if there's any mix up with the screen. But anyways, I mean, listen, we're looking at a number of things, but what I meant by that is that I'd love to move everything over to an operating line, whether it's 20 million or 15 million or something like that, something where we have interest payments only, and where we can have the liberty as paying as much off when we want. And so it would be much more flexible for us instead of dealing with a term facility. Here's what happens when your profits are bountiful and the company's going good. The banks come to you and they don't want you to pay the debt off. They want you to just meet the interest payments, and sometimes they even say, like, forget the interest payments for a while, because they love the security of the investment. And then that old saying that sometimes you don't get umbrellas when it's raining. Then the reverse of that is true as well. What we have right now is a measured, collaborative approach with BMO. They're working with us. They believe in us, and I think that it will all come to fruition over the coming months ahead, and we're going to come out on the other side, and we're going to continue to grow as a company, is what I believe.
All right. Yeah, that was good to clear up that you're not looking to just eliminate the whole debt, like 60 million.
No, I mean, listen, we could, right? But it's not who our company is. I mean, we're committed to technology. We're committed to growth. And so, we're not going to jeopardize that and put that, at risk. There are some that are less bountiful as far as profit margins than others. I'm not going to get in who they are, what they are, where they are, because it's not appropriate, it's not fair. But let's just say that we have plan A, B, and C, so we're going to come out on the other side.
Yeah. So in summary, I would say you're not looking to raise money again later this year, and the things that you have said about Q3 and Q4 before, they still stand. Yeah. All right. So that's good. About the disposition, you probably can't say like what you're looking to sell, but can you say, like, are you already like far away in the process, or are you like?
Well, sometimes when you're in a process and you think you're right there, sometimes it's like this, and sometimes when you're like this, it turns out to be like this. We have a plan. We're executing on it, and we're hopeful that over the coming months that that will all come to fruition.
Yeah. Well, could you say like what parts of the business are definitely not going to be sold?
all the technology driven businesses are not at risk. I mean, what we want to be is we want to be 70%. Our goal is to be 70%, profitable, 70% profit margins, and 85% tops gross margins, right? And so businesses that require a whole bunch of people are going to change. Let me give you an example. Our title business, we've lost, since inception, we've been losing $300,000 a month. We've made some radical changes. We've imported some new technology that we developed, and we're going to be profitable in August for the first time in 3 years. And going into 2024, we're going to be substantively profitable. And so we found a way through a combination of technology, like, for example, when you order title, you start off with what we call a starter kit. Starter kit requires a whole bunch of information on the property, on the people, on their income, on the debt, MERS collections. Just there's a whole bunch of information that has to be put together by the loan officer. And it costs, or the title officer, and it costs on average a title company $130 to produce. We're out there right now talking to certain title companies right now because we have a platform that will be fully operational within the next 4 to 5 weeks, that we can fully digitize that starter pack and offer it for $60. Now think about it. One title company that we're talking to at the outset that does 26,000 transactions a month, they would put $1.5 million in their pockets, bottom line, and be able to turn around and get titles that those starter kits produced to them within the same day. Tell me what a boom would that be to be able to add $18 million to their bottom line and have more proficiency, efficiency, and accuracy. It's just, it is going to change things. So what we're doing is, we're adding technology to the title side of the business to make, not only what we're doing, more profitable, but we're outsourcing some of our title products that Jim, previously held in-house. So for example, our title company would had upwards of 50 people at one time, is going to be reduced down to probably before the end of the year, probably down to 8 or 9 people. Yet we're going to be increasing our output substantively. A lot has to do with the attorney opinion letter and how we're going to be moving that out. And so, stay tuned for that. But, that's just one example of how things will be turned around. When you lose 300 or 350,000 a month and turn around, in one month, August will probably, kind of break even, make a little bit of money. But, it's not, we expect our title business to be making millions a month, going forward as we start boarding our title kits, starter packs on there. It's going to take some time, one by one, but it's going to be an extremely bountiful business. It's going to be a high margin business because all of our data, all of our technology is built. So the costs for us are de minimis in relationship to the savings and our benefit and our profits. That's just one example. And I could go down in each business unit and say how things are going to change.
You set a goal for the AOL transaction, like you said, 1,000 a month by the year end. Where are you going right now?
Well, I'm hoping it's going to be more than that because we've taken a different tactic, and I don't really want to divulge what that tactic is right now, because just like everything else, you want to be measured, and we're in the middle of contract talks with a number of different entities. But we're going to have a lot of other people selling it for us. And so we think that, we're still extremely excited about the future for AOL. We think it has a potential. I'll give you an example. We built a BestX platform. And what that platform is able to do is to go into every property in this country, and determine based on, and I have to also say, there's been a massive shift too, that now we're going to go to new purchases. That's where the biggest bang for the buck is, for AOL. Refis, there's not as much difference as what we're hoping for. New purchases is where, where we're going to be. And you're still seeing, a strong market. Yes, it's been off because the interest rate increased, but there's still a strong market for new purchases. And effectively, we can save the owner as much as $1,500, in title, $1,500 versus the $3,000 they're paying. And so we've come up with a new concept of how we're doing that and how we're selling it and how we're partnering with it. And, we expect it to be bountiful as far as the number of transactions a month. So that will be introduced in 2023.
But so far, have you been increasing the transactions?
Well, de minimis right now, because as much as we need the banks, to approve it, they need to be able to switch over, to enter it. So we have 25 major banks, that have, pilot tested it. We have one major, entity right now, servicer, if you want to call it, that is 100% committed to it, and they do thousands a month themselves. So we were supposed to have started that last month, and there's some technology issues that they're dealing with, but when that kicks in, it's going to be, just one alone will meet our criteria. So and then, as I said before, without me being too secretive, we have, in addition to that, we have a number of other opportunities, Blue Water, on all of the new purchases, and that we'll be able to bring, AOL into the play as well. So, we have a number of different venues for AOL to take place, and it will be everything that we expected to be, and a little bit better.
Yeah, I think Jim set a bit of too high expectations for it.
Pardon me?
Like, I think Jim set too high expectations for it. He said like 10,000 transactions per month.
Yeah,
by
listen.
the end of last year, so that kind of I think
So,
that was
so the thing is that if you're going to criticize me, every criticizing is because I've been too enthusiastic about my business. I'm passionate about it. I love my business, right? And yet,
you say that. Jim said that.
Pardon me?
Jim said that 10,000.
Yeah, well, that's Jim's not here, but it's possible. It's possible to have more. But all I'm saying to you is, and I expect that we're going to do very, very well. But as I said before, yes, I'm passionate about my business. Yes, I put my money where my mouth is, and yes, we have high expectations for where we are. But what I'm, want to do is to be somewhat measured too, because there's nothing more than you want me to say, yeah, we'll do 10,000, and yeah, we'll do 8,000, yeah, we'll do 6, and then you'll be on the phone with me next week and said, well, you said you're going to do 10,000, you only did 5, like you're a failure. So what we need to do is to be profitable. What we need to do is have high profit margins. What we need to do is grow this business in a formidable way. What we need to do is be responsible and be, and ethical in everything that we do. And so, if there's anybody that's going to make sure that that's happening, it's going to be me. And as you know, how many times have you called me? How many times have any of your writers written me that I haven't had responses back in an immediate way? Every shareholder means something to me, and not often that you get CEOs that are opening themselves up and making themselves as much available. You deserve this and more, and you deserve transparency and more. And with transparency, sometimes you don't always meet expectations, right? You just don't. It's not for a lack of trying. There's just so many things that can impact a marketplace. and you guys are all really well-educated people, very informed people, worked really, really hard for your money, can't afford to lose money. I get it all. I get that. And I put myself in an even more vulnerable position by continue to put more and more into this company to make sure that we don't, or that we do meet expectations. So only know, like, we're trying, like we're really trying, and I really still am passionate about this business.
Yeah, I gotta say you can't usually even reach people who are investor relations in companies. Send them emails.
But
They don't.
but even on an individual investor, there's not just you. There's many that write me, individually on many occasions, and so I respond. I answer their questions. I'm not ducking it, right? And I love the business. We're going to be okay. I really do believe that. If I didn't, I wouldn't be continuing to put money in. So I believe in it. We
Yeah.
couldn't participate, by the way, in this investment because, number one, there are some things that we're doing right now that basically freeze us out. Fourth quarter, first quarter, second quarter, potential dispositions, all of these things that come into play that don't allow us to trade, right? And so we were committed to come in, but we have to wait till we're able to free trade. But we will be putting more individual executives will be putting more money into this company. It's just when we can.
So you can't buy on the open market right now. All right.
Can't trade.
Right.
Cannot trade. We are precluded under the rules of the Ontario Securities Commission. We cannot. When you have insider information and you're in the middle of dealing at whether it's financial reporting or whether it's any material, any kind of acquisition or any other thing that could impact the stock, they do not allow you to trade. And so we couldn't participate, or we would have participated. But quite frankly, um, giving warrants, made me sick to my stomach, right? But giving warrants was necessary to be able to raise some money. But as I said to my executive team, no way that we're going to be, as management, participate in that and get warrants. If we're gonna invest, we're gonna invest on the market value of the stock at the time. We're not going to participate in that. It's not something that we wanted to do. It's something that is required and based on economic terms. How many people do you know are raising money successfully today in the small cap space?
Not many, but yeah, it's good you answered that. I gotta get people ask if they are participating. But about one of the business units, foreclosures are slowly going up, and you also had the business that you do with foreclosures. That's the Jim's business, correct? And
yeah, defaults. That's right.
And you changed where you are charging it, and from what I understand, the revenue dropped from it a lot in Q1.
Yeah, well, it was just, listen, Jim's a good guy. Jim's, what he's doing is best back running his law practice to try and increase his business. It was a decision that was made. We do all of the default work. As long as we're doing it properly, we do all the default work for the law firm. And so him growing that will improve, our business, right? At the end of the day, we needed to separate church from state. Jim owning a law firm and Jim being the CEO of Voxtur created a lot of transparency issues. And so ultimately he made the decision to step down because, number one, he wanted to, improve the law firm, which would improve our business, which would also take away any question whatsoever about conflicts. And so we're in the position right now where within the next 14 days, all of the Soft Pro licenses and title will be in our name. All of the data in that will be transferred onto our platform. There'll be no interconnection whatsoever between the law firm and Voxtur other than business. Genuine bona fide, a willing seller, willing buyer businesses, right? And so that's gone, and that's not a bone of contention anymore.
Yeah. So, I guess a lot of us are interested, like, what did your default business do, like pre-COVID, in normal foreclosure levels, and
Yeah,
indicative of what will happen in the future?
yeah. Well, what happened before we bought Jim's business? Obviously, we'd had quality earnings done. We had audited financials done. In his heyday, he was making $2 million a month,
In
right?
revenue or
Pre-COVID, no, in profit,
profit?
right? In profit. And he fell by as much as doing 2,000 to 3,000 defaults a month, drop down to 150 to 200, because what happened is COVID was a massive kick where nobody could, there was a moratorium, right, on taking anyone's house or on defaults. And then during that time period, you can explain probably better than me, but at that same time, housing prices rose in unprecedented levels. And so ultimately what happened is people increased their equity, position. And so rather than I can't make the payments, then I'll sell because I have enough equity in the house that I don't have to default. If I can't make my payments, I'll sell. And so we're not back yet. The defaults are not even close because prices still continue to rise and people still have equity. So what we did do, though, is we built some bankruptcy technology. And just to give you an idea, when a major bank calls it bankruptcy, it's really not bankruptcy. It could be that they're late on a Visa payment. It could be that they didn't pay a utility bill. It couldn't be maybe they didn't pay their property taxes. What that is an alarm bell that goes off to the financial institution saying, hey, we got exposure, to this individual, and we see things happening. So what happens is files get opened. And, in the United States, there's a very regimented, detailed legislative process that you must follow. And it's complicated and it's long, and it's certainly very strong encumbrance on people to get this done. In conjunction with one of the largest banks in the US, we built what we call our bankruptcy digitized process. It takes into consideration every rule that exists. And basically, we've been building that in conjunction with them. We've now been awarded it. But there's always a but, isn't there? But what we have to do now is connect our API into that bank, and that process is just going through a process right now to get the API connections in. So basically what we set out is we believe that we will start this process in January of 2024. Now, a file based on that, which we will save, and we've proven that we'll save millions of dollars a year for each bank to eliminate the man-made process in a material way and rely on the digitization. We get $7 a month is what our fee is per file. And so some of these major banks have 60, 70,000 files, that they're ongoing at every time. So we get paid $7 a month. We think it's going to be a very, very lucrative business for us because of the digitization. We haven't really even talked about that, but we're continuing doing things because we have the data, because we have the technology, because we have the cerebral capabilities to kind of put two and two together, and because we have the relationships with these financial institutions, we continue to augment the services that we provide.
Yeah. All right. Well, that sounds good. But for those people, like I know people who are like in this stock, they're like, I'm doing it as a foreclosure play. So, I mean, 2 million a month, it would be very big in the current valuation. So, do you think it's possible to return to those levels when the foreclosures return to normal levels?
I think that it's going to take some time,
Yeah.
right? But what is also happening is that because of what's happening in their industry, for example, with title, there's a lot of title businesses that are just can't make it. If you don't have large enough volumes, you're just not going to survive. So you're going to see a lot of sometimes there's going to be addition through subtraction. And that way, and what I mean by that is maybe the volumes don't change as an upward position as much as you want, but because a lot of your competitors are falling by the wayside, you're able to survive, your business will incrementally grow. Same thing is going to happen, on valuation. You've heard Fannie and Freddie say that they're going to rely on sketches, floor plan layouts, and AVMs as opposed to having to go through material, process through appraisals, and which is cost effective and timeliness. So you're going to see a lot of AMCs probably fall by the wayside because they got to do 10,000 transactions a month, and if they don't, because of the licensing and the all of the legislative compliance, that they have to adhere to, if you don't have that kind of volume, you're just not going to make money. And so you're going to see a lot of additions through subtractions too. So, could it get to that? Yeah, but it'll be at the expense of a lot of others that didn't make it.
All right. We have time. Let's try to get some of these relatively quickly.
I know. Yeah, we've got about 10 minutes. So
not many blue water questions, but let's get this. The Workster Well, it's kind of been not discussed anymore that much, but is that still in play? What's the plan with Workster Well?
Voxtur Well, it's the platform is built, and it's certainly a very viable business, but that's one of the businesses that have been put on hold because we felt that the long-term prospects of that is still extremely high. But the cost in getting it built up to that is something that we had to just, one of the things that we had to put a bit on the back burner, where we felt that we could get more instant gratification from some of the other businesses. The platform is built, it's going to take, some work to get, customers and that built onto it and continue to build it out. It is certainly on our part of our strategic plan. It's just not going to be immediate now.
Yeah, when you are in better position with liquidity and profits.
Right.
All right. So some like blue water people have been following this number. Is it RAUM or AUM? Like blue water has like assets under management, or is it regulatory assets under management? It has been shooting up. So people are asking, like, and I'm asking that is there like a management fee on that, and what does it really mean in the context of blue water?
Management fee?
Yeah.
I'm not sure what you mean by that. I mean, blue water, we get paid in the following way. If we're providing pricing or hedging, we get paid a fee for that. If we facilitate a buy or a sell, we get paid, a fee on that. If we do transfer, due diligence, we get a fee for that. If we facilitate them going into a shell Fannie Freddie ticketed entity that we have, we'll get a fee for that. So we get fees for everything that happens. We'll get fees for if you're seeing a lot of buybacks right now where Fannie have sent loans back to the people that bought MSRs. So in order for us to be able to help our clients and fix it by maybe doing a valuation, fixing the title, requiring documents, the underlying mortgage documents to be cleaned up, we'll get fees for incorporating a lot of Voxtur services. That's how they make their money. So I'm not sure what you mean by a management fee.
I mean, well, because there's this chart been floating around with blue water and assets under management is like 6.9 billion in March. So like, what? I guess what's that? What is
well, basically we do a lot of work for a lot of major servicers and sub-servicers, right? And when we take a look at all of the, what we call correspondents or banks, we probably have close to 1,000, over 1,000 banks that we actually are involved in, directly or indirectly through using our platform or being involved directly by doing, whole loans or, non-QM or MSRs. So that's continuing to grow. One of our largest clients have over 500 on their own. We just did a deal with the Mortgage Collaborative who had over 250. Then we have a number of other institutions that we have worked with. So essentially, yeah, there's a lot of work, whether it's directly or indirectly, and I don't even know how many billion it is, because that's something that Al, can talk to you about on more on a day-to-day basis. But the amount of transactions and that we're dealing with on a daily basis, is large and touching.
Yeah, but there's no management fee on that. Right?
No,
Alright.
we get paid for in the areas that, I've indicated to you on.
Yeah. You said in the earlier part, like it sounded like you said Round Point, like Round Point itself was a client still, or returning as a client.
Round Point historically was owned by a large client of ours, and essentially they were sold, and we were doing basically flow work for them, like we were trading loans on a monthly basis. And so when they were sold, the vendor that sold it was going back to all of those those clients, those 500 some, and started boarding them back on, so they would do flow differently under under their main umbrella. In the meantime, we were precluded from, or Round Point was precluded from competing, with the vendor. And so what it's meant was that it hurt us on a short-term basis. But some of those correspondents are being boarded on as we speak. I think there's about 48 that have been boarded on to date. And so our flow is starting to happen, but it's going to take a bit of time to build that business back. But that hurt us on a short-term basis, and couldn't have come at a worse time, because it basically transpired a month after we bought the business. So it didn't go away. It just has been adjourned.
But the TMC, like it was a bit hard to put it on scale, because it's not one company. You can find financials.
Yeah, I mean, you have to be a member.
How big is, like how big is the TMC opportunity?
Well,
like
we think it's we think it's very large. We think it's large. There are over 250 members. They range from credit unions to small banks to basically and some large financial institutions. And so what we offer, the Blue Water offerings, whether it's trading in MSRs or loans or non-QMs, etc., we're the only one within the Mortgage Collaborative that offer those services. And so essentially what we're doing now that we've signed that is two things. Number one, starting to engage with some of the members. We'd like to engage in all of them, but it takes time. And making them aware of what our service is, and then basically providing an opportunity to be able to allow some of these smaller banks to participate, with other banks and start buying MSRs. Like some small banks say, we only work in Louisiana, or we only work in South Dakota, or we only work in Iowa. But what happens if we bought some loans and we were able to take all of those loans that were in each state, and basically through our super transfer, assign all of those purchases to individual banks rather than one having to take responsibility for it all. So we have that ability to deal with that because of the super transfer platform that Al Qureshi built. And so the opportunity's there. The other opportunity is basically the due diligence, insured due diligence. Here's something for you to take into consideration. When people buy MSRs today, the typical purchasers take 5% of those MSRs and they review the loans. And, and if there's no material defect in that sampling, then they buy it, they take a flight. And so it's very expensive because everything is done manually. It's like $500 or whatever they spend to do that 5% review. We've come out with a fully digitized process where we can do 100% of that review for less cost than what it does for them to do 5%. And we have insurance that we're wrapping around it. So what is happening right now is we're basically starting that process right now. We call it post due diligence and pre-due diligence on all these platforms with fully insured platforms. So what we're finding right now with Fannie and Freddie, some of the loans that they've taken on is they're asking the vendors to take back those loans because there's defects. And think about it, MSI represents 2%, of the loan, right? And basically, as far as what it means. So if they have to take back a whole loan, let's say a loan's $300,000. I mean, it's 50 times what they would have made, on one MSR. So if all of a sudden you're taking back, 100 loans, then it could, basically totally detonate the whole MSR. So what we're saying is that we have the ability through our digitized process and insured process to mitigate, any defects that are existing. Now, there's nothing anyone can do right today, anyways, to deal with how do you deal with fraud or misrepresentation. So we're dealing with that. But basically, we think that 92% of most of the defects we've got covered through our insurance package. So it's a pretty amazing thing. And so Al's being very aggressive to go out there and sell that due diligence now, right now. So it's gonna be a big change in the business.
All right. I mean, it seems like we are running out of time.
Yeah.
We have a lot of questions about the business, but we had to spend a lot of time on the race.
So why don't I agree to this? How about every month? Set a date and a time for every month. I'll use you as a channel if that's okay with your investment group, and happy to give you an hour. It doesn't mean that I won't respond to whatever questions some of your individual investors want, but I want to be accessible, right? I want to be as transparent and honest as I possibly can and be informative as I can, but there's only so many hours in the day. And right now, 85 of them a week, or 85 hours of those week is taken to me running that business. So it's really, really difficult, but you are important. So I'm happy to set up, at a subsequent time, you and I can agree on what, when the appropriate time is, and that way you can have a forum for your investors. I'm grateful and I'm thrilled that people in your country and many of the others around there have taken an interest in this. I do not want to let you down. I want to grow this company, be improved and improve it. I want to be as transparent as I can. So I'm happy to have a regular fireside chat with you on a monthly basis if that's something that you feel is desirable by your investors.
Yeah, I mean, I could do it as long as I'm in this investment. I could do it definitely.